Welcome to TheoTrade. This is Don Kaufman. Here we are doing the weekend update on September 16th, 2017. Let's get right to it. SPX closes dead on 2,500. S&P futures also dead on 2,500. The Nasdaq, roughly speaking, closes right on 6,000. Specifically, that is the Nasdaq futures in what can only be described as a fairly lackluster week in terms of trading. For those of you that do trade on an intraday basis, well, let me bring it up this way. I'm going to take the SPX and we're going to drop out to an intraday time frame just to display the week. We're going to go 5 days, 5 minutes, just to display ultimately what happened this week. And the answer is, well, for the most part, we rallied a little bit on Monday. We gapped into a higher open on Tuesday, and people, we did not move thereafter. I'm also going to add in here to this chart our expected moves because I want you to see what ultimately happened on the week here, and I'll kind of zoom out for just a moment. So this was the entire week of trade. Again, ultimately we gapped a bit higher into Monday. Opened higher on Tuesday, and all we did is just skirt the edge of the expected move throughout the course of the week. Got a little bit of a bid into Friday. I mean, that's it. That's pretty much the week at large. And when you start to zoom into this a little bit, you realize that the SPX during trading hours, I mean, they had a range here from roughly, we'll just call it 24.92, okay, to the high end of 24.98. People, we didn't even have but a 6 or an 8 point range the entire trading week over here. And the reason I'm bringing this up is, again, the entire move was made on Monday, and it was, pretty much a flash in the pan out there, and it was all over, and the week ultimately did not move. Now, can the same be said for the Nasdaq? If you go take a look at the Qs, okay, and I'll kind of zoom in over here for a moment with expected moves. Much of the same out of the Qs, a little bit more volatility maybe coming into Thursday, but again, skirting right along the edge of the expected move throughout the course of the week. Now, let's get into a few specific details over here of what performed well, what didn't perform well. One underlying that I've actually got my eye on into this next week would be, of course, Google. So the performance of ultimately the Nasdaq is fairly stellar this last week. Okay, of course, the S&Ps are closing at an all-time high, 2,500, as we said, dead on. Google not involved in that performance whatsoever. And coming into this next week, once again, we're going to be facing, looks like this 920 level. And I wanted to cover that right up front because where we've seen a degree of leadership in the past inside of Google, it has not performed as well as many of the marquee NASDAQ stocks. And it's my belief Google getting under 920 is a sell for the entire NASDAQ. Again, we're 15 points ultimately away from seeing exactly what that's going to look like. But let's change up a little bit here and start to look at some bigger and much more notable products. One thing that I do not kind of prototypically discuss on a week-to-week basis, of course, would be the dollar. And it's appropriate, I think, to discuss the dollar as the FOMC is going to have a meeting this coming week. Again, for those of you unaware, coming into this next week of trade, and this next week of trade starts again September 18th. The FOMC kicks off their meeting. We'll have their announcement on September 20th. So we've got an FOMC meeting, a dollar that's been getting crushed lately. We get a bit of a bounce earlier in the week, but quite frankly, this looks like we're going to see continued downside inside of the dollar. Now, the reason I'm bringing this up is specifically, I believe that the FOMC will be mentioning a substantial amount, okay, about what has become a dollar that's getting devalued now. However, when you start to look at this from the FOMC's standpoint, it's probably they're fairly happy about it. Why? You start to whack the US dollar a little bit, that ultimately causes the inflation that they're so desperately looking for. Okay. Do I expect any surprises out of the FOMC? Well, first of all, I don't expect them to go ahead and raise rates here in the September meeting. Nevertheless, okay, regarding their inventory, and that is, if you're unaware, the balance sheet of the Fed, I do expect a couple of announcements on that front. Okay, there's another little bit of a change up though in here as well with the FOMC. Okay, first of all, the markets, they're not anticipating anything, and I want to bring you into the SPX for just a moment. And I'm looking at this earlier, and I'm just fairly shocked. If you take a look at the SPX, and I'm going to tighten up the number of strikes on here, the SPX options. Okay, there's a Monday expiration, there's a Wednesday expiration, and ultimately there's a Friday expiration. So here you go, Monday, Wednesday, Friday. On the right-hand side of the screen, of course, we have the implied volatilities. These implied volatilities will tell us a lot about what the market is kind of interpreting risk to be. For instance, coming into this Monday, there's less than a $9, it's a $9 expected move. So that includes all the week for the, all the weekend risk and through Monday. Again, if you look at this, the expiration is September 18th. It's saying, from Friday all the way through Monday's close, they're really only expecting like a $9.36 move. One of the things that really stands out to me, though, is this Wednesday expiration. The volatility is 7.15. Ultimately, what that means is the marketplace not only isn't anticipating anything coming out of the Fed, but they're clearly and decisively saying, okay, we're not going to budge. There's only a $16 expected move. That's through Wednesday's close. So the marketplace is anticipating extraordinarily low risk for this week. And this is precisely, and the reason I'm bringing this up with that FOMC meeting and so forth, this is precisely the reason I am not going to be selling any premium. Not in the, we have a tetrapod spread. I'm actually not kind of embarking upon this tetrapod spread this next week because frankly, I don't like how low the volatility happens to be. And again, regarding the FOMC announcement, okay, I'll make this very, very clear. What I believe those comments are going to be out of the FOMC, neither here nor there. What I think is going to happen, though, is that if you take a look at the bonds themselves, they actually sold off pretty hard and fast, okay, in the last couple of trading sessions. I think we're going to get a bid back up, which is ultimately going to take interest rates a little bit lower. That would be a little bit more of a dovish stance. Now, here's the comments I think that are going to come out of the FOMC. They're probably going to talk about the hurricanes, okay, and maybe even have a little bit more of a dovish stance than they have as of late about raising rates, okay? You have to recognize the FOMC at this point, they're probably looking, okay, at the fact that the bonds got whacked back here this last week. They're definitely looking at the dollar, which has been getting crushed lately. Again, they're quietly cheering the fact that the dollar continues down. That's going to help them with inflation. So at this point, I think they're going to play wait and see. They're going to have a little bit of a dovish stance. Okay, I've actually taken a long bond position. Okay, a long bond position for this next week, thinking that the bonds are going to get bid back up. If you're not comfortable just buying bond futures, which, I mean, should you be comfortable? The bond futures, they move a point. You make or lose $1,000. You might want to consider doing something inside of the TLT. You could use a bullish spread, define your risk in the TLT. But again, this is a rather short duration position that I'm looking for. I'm just looking for bonds, once again, to get bid back up into this FOMC meeting. All right, so let's switch gears. Let's move away a little bit from the FOMC announcement, which, again, I don't expect a whole lot, and the market doesn't expect a whole lot, okay? Let's go back for just a moment to volatility, okay? And what you're looking at right now happens to be the expected moves specifically in the SPX. One notable aspect is throughout the course of this last week, and again, I'm going to highlight, here is the last week of trade. Very, very notable. Again, right out of the gate, we shot up on Monday, and this was a $31 expected move that we had last week. Not only did we edge along it, we exceeded it ever so slightly. Okay, so again, the expected move was exceeded last week, and last week we had some increased volatility. Now, in this coming week, okay, what's incredibly important is to just take a quick glance at the expected move. It's under $21. So again, last week we had this $31 expected move. This week, $21 expected move. Again, the markets are not anticipating any volatility. Now, do I see opportunity here specifically in the SPX? Yes. Okay. Volatility is rock bottom. Buying premium can work. However, I'm not looking at buying premium specifically in the SPX or specifically in the spiders. Okay. I think it's even more advantageous to consider looking at the Nasdaq. So let's go over to the chart here for just a moment. These are the Nasdaq expected moves. And again, I'm just, I've got all the expected moves kind of labeled. What we saw last week again is the Nasdaq coming up, edging along its expected move. This next week, the expected move is contracted. What that ultimately means is that implied volatility is incredibly low versus what we've seen as of late. And, how do you know that? Okay. Well, first of all, you can kind of see it visually here. If you do look at these expected moves on a week-to-week basis, you can kind of see like, all right, I get what he's saying. This expected move is a lot less than the previous week. Okay. Similar to the week prior to that. But again, this is one of the lower implied volatility weeks that we're going to see inside of the Qs. So you can go back also, if you're on thinkorswim and you go to think back, you can kind of click over here. And again, here we are on the 16th, but you go back about a week in time and you can explore the volatility last week was sitting at about 14.82. This week, it's sitting at 11. So again, on a percentage basis, these are vast differences, right? So for the most part, you can buy premium at about an 11% implied volatility. And you're like, well, what does that really mean? Well, it means for you, if you buy premium, you want us to move outside of what's expected. And the Nasdaq, it's pretty good at doing it. And you can see this past week, touched the expected move, came in. The week before that, we actually did exceed expected move. The week before that, blew through the expected move. Nevertheless, implied volatility has contracted substantially. And I think that the better opportunity, if you're going to be a premium buyer, would be inside of the Qs specifically. All right. Again, I want to switch gears completely now. And I want to take a look at something that's really kind of been just agony for options traders. Whether you know this or not, we're going to take a look at skew, which is literally causing, as I said, like some agony for options traders. I'm going to go to skew and I'll explain specifically what we're looking at here momentarily. Skew. First and foremost, what skew is, it's looking at options premium. And there's actually a symbol called skew, but it's looking at options premium in the SPX. And I always call the SPX, it's like the granddaddy of all the options products out there. And skew in the SPX right now is nothing less than phenomenal. And what that amounts to, and I'm actually going to show you, let's come off skew for a moment and go into the SPX. And we're going to open up a chain. Let's just go out about 30 days just to kind of prove a point. And we'll open up about 40 strikes. Got tons of strikes opens. And we're going to go over here to implied vol. What skew measures is these out of the money puts. And I was talking about this in the Thursday video that I did. The skew measures the out of the money puts, versus, the out of the money calls. So if you start looking about equidistant, these out of the money calls, we get all the way down to 5% implied volatility. Meanwhile, the out of the money puts, are at almost a 12% implied volatility. And I say that this is just agonizing for options traders because it limits our capabilities of the types of trades that we can place. Anyway, the skew right now is nothing short than phenomenal. And you can actually measure, there's the skew index over here. And this is like a 10-year daily. This thing has not been measured for that many years. But we'll actually bring up like a 5-year weekly, and you can see that skew right here, right now, it's one of the highest points that it's ever been. And all that means is, again, for the most part, people are buying out of the money puts, and they're financing buying those out of the money puts by selling calls, and it causes more and more skew in the marketplace. What does it do to us, though, as options traders? Okay. Well, as options traders, and, I'll actually use the spiders in this particular circumstance, might make this a little bit easier to create a trade. As options traders, okay, it limits our ability to want to go out to sell a put spread. There's no volatility, first of all, to sell a put spread. So selling options premium, what are you going to sell? I mean, legitimately, you start looking out, look out even 30 days, okay? And you start shaking your head and you're like, I don't, not gonna sell anything out there. You go out even 34 days, okay? Look at how low some of the premiums are. I mean, selling a 245 put, that's 34 days out. You got $1.25. And if you sell a put, all right, let's go in here and let's say we sold this put and then bought, for instance, okay, the 240 puts against it. This is a $5 wide spread, people, for a 48-cent credit. And the reason that the credit is so incredibly low is, again, the puts that you're selling are a 9% vol. The puts that you're buying are almost a 12% vol. It's actually one of the largest skews that I've ever seen inside of a chain. Okay. And yes, you can measure it by the skew that we just looked at, the skew index. Okay. But it doesn't give you the full inflection of how wild this skew happens to be. So you can't sell a put spread if you want to be bullish. You just can't do it. I mean, what you're going to collect on there, again, it's a $5 wide spread. That's just a little bit out of the money, okay, for the next 34 days, and you collect a whopping, what? You don't even collect 50 cents. You're taking $4.50 of risk. Don't do it. If you're looking right now for trade opportunities, first of all, if you're bearish, the skew will help you. If you want to be bearish, it becomes easy. You use stuff like in-out spreads where you go out there. Look at this. You could buy a $2 wide spread for 81 cents, okay, and the trade is already in the money by 81 cents. So being bearish is relatively straightforward. Again, kind of review this video if you want to look at a couple of trade opportunities. This is your bearish trade. How do you get bullish? How do you get bullish? Really, one of the only effective ways to get bullish right now in a major index product like the spiders, but this is also going to reverberate right through your equity products, your Apples, your Teslas, okay, your Facebooks, any of them. If you want to get bullish, the way to ultimately do it, you're probably going to have to get a little bit cute and use stuff like ratio back spreads, okay? And to do this, it's just a 1x2, and you can see it's for a 6-cent credit. And I'll come over here and I'll analyze the trade. Now, I'll clean out my analytics for just a moment and give you a clean kind of interpretation to this trade. This is the bullish trade right now of choice, is to use some type of a ratio back spread. And if you don't love the trade, let me show you why it works, okay? Because for the most part, you're selling like an at-the-money option, right? Here's the 250s. You're selling an at-the-money option for right around a 7.7 vol. And then we're buying two of what? A slightly lower implied vol. So what I'm trying to do is get the skew working for me. Those that are going to go out there, they're going to sell put spreads and so forth. You're going to get skewed. It's just as bad as it sounds. But if you go out and you're buying a ratio back spread, by the way, you're buying this trade, but it's done for credit. Okay. And that's always confusing to people, but the trade has a little bit of risk inherently in there. Anyway, I just wanted to show you an example of how to do a bullish trade in what has been an incredibly difficult environment, in essence, to be able to place those bullish trades. So again, things to think about for this week to come. If you want to get bullish, look towards things like ratio back spreads. If you want to get bearish, use that in-out put spread that I showed you a moment ago. As you look through like the list of the usual suspects over here, you'll also note the market is not paying any attention to news. You know, I didn't even mention so much about North Korea and the fact that the S&P futures that evening only moved 6 points. That data came out of China didn't even impact the S&P futures. This marketplace is turning a blind eye to everything. At this point in time, I like being net long volatility. I also want to be a premium buyer. Okay, premium buyer, as I said, and I'll reiterate this over in the Qs. The Qs are sitting back to an 11% implied volatility, okay, for the week to come. Now, we don't know necessarily if volatility goes up or down, but each and every week we have been tracking, okay, how often the underlying is cracking outside of the expected move. And the odds are pretty good given the fact that the implied volatility is this incredibly low with all the news, again, coming this next week. Is the market ultimately going to start moving more than what's implied? That's why right now I'm a premium buyer, not a premium seller. I'm a premium buyer and looking for the market to exceed what is expected. That is, of course, the expected moves. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.